Have you ever been promised an investment that guarantees high returns with little to no risk? Maybe a friend, a coworker, or even a relative told you about an opportunity where you could double your money in just a few months. It sounds exciting, but here's the problem. Investments like that often lead to financial disaster. Filipinos work hard to earn money, and naturally, we all want to grow it. Investing is one of the best ways to build wealth, but not all investments are created equal. Some are legitimate but highly risky, others are simply unsustainable, and the worst ones? They are outright scams designed to steal your money. This video will show you exactly how to spot a bad investment before it's too late. By the end, you'll know the biggest red flags to watch out for, whether an investment is just too risky or if it's a straight-up scam, and how to protect yourself from financial loss. Let's start by looking at real-life scams that have cost Filipinos billions of pesos, and what we can learn from them. One of the biggest financial scams in Philippine history was Kappa Community Ministry. This so-called religious organization promised investors a monthly return of 30%, far beyond what any legal investment could ever guarantee. Thousands of Filipinos, including retirees, OFWs, and small business owners, poured their life savings into Kappa, believing that their money was being blessed. But it was nothing more than a Ponzi scheme. Early investors were paid using the money of new investors, and when the system collapsed, many were left penniless. Then there were the online crypto trading platforms that popped up over the past few years, luring in investors with promises of easy profits. Some of these platforms hired celebrities and influencers to endorse them, making them seem trustworthy. But when people tried to withdraw their money, they suddenly found their accounts frozen. The platforms vanished, taking millions of pesos with them. These scams all followed a similar pattern, promising huge returns, rushing people to invest, and making it difficult to withdraw funds. Yet, despite these warning signs, many Filipinos still fall for these traps. In this video, we'll break down the biggest red flags of bad investments so you can avoid becoming the next victim. Let's start with the 3 types of bad investments you need to watch out for. Not all bad investments are scams. Some are simply too risky, while others are built on shaky foundations that are doomed to fail. To truly protect your money, you need to understand the 3 main types of bad investments: scams, high-risk investments, and unsustainable business models. The most dangerous type of bad investment is a scam. These are designed with only one purpose: to take your money. A classic example is a Ponzi scheme, where early investors are paid using money from new investors. The system appears to work as long as people keep joining, but the moment recruitment slows down, it collapses, leaving most investors with nothing. Another variation is the pyramid scheme, which focuses on recruitment rather than real investments or sales. Participants are often required to pay an initial amount to join, and the only way to earn is by bringing in more recruits. While this may look profitable in the beginning, the structure is unsustainable, and those at the bottom of the pyramid eventually lose their money. Then there are fraudulent investments, companies that claim to invest your money in stocks, real estate, or cryptocurrency, but are actually pocketing it. They might show fake profits at first to build trust, but eventually, they disappear overnight, taking everyone's money with them. Some investments are real, but extremely risky. The problem is that they are often marketed as sure wins, hiding the true level of risk involved. For example, trading in Forex or cryptocurrency can be profitable, but it is also highly volatile. Many so-called trading platforms promise guaranteed profits, but in reality, even professional traders lose money. The risk is further increased when people invest without fully understanding how these markets work. Another example is investing in small startups without proper research. Many businesses fail within their first few years, and just because an investment sounds promising does not mean it will succeed. Without a solid understanding of the risks involved, investors may end up losing their entire capital. Real estate can also be a high-risk investment if not done properly. Some projects are marketed aggressively as the next big thing, only for construction to stall or for the company behind it to go bankrupt. Investors who fail to do their due diligence often end up stuck with unfinished properties or worthless contracts. The third type of bad investment is one that looks legitimate, but is built on an unsustainable financial model. A perfect example of this is when companies offer unrealistically high interest rates or dividends without a clear source of revenue. If a business is paying investors 10% per year, but is only earning 5% from its operations, it will eventually run out of money. At first, these companies may be able to pay investors using new funds coming in, but once growth slows down, everything falls apart. Multi-level marketing companies that focus more on recruitment rather than selling actual products also fall into this category. While some MLMs are legal, many fail because they prioritize signing up new members instead of creating sustainable income through product sales. When recruitment slows down, members at the bottom of the structure are left with unsellable products and financial losses. There are also companies that expand too aggressively without a solid foundation. They may take in huge amounts of investor money and spend it on expansion, hoping future profits will eventually catch up. But if the market shifts or demand does not grow as expected, the company collapses under its own weight, dragging investors down with it. Now that we've covered the three main types of bad investments, let's move on to the specific red flags you should look for before investing your money. Now that we know the different types of bad investments, the next step is learning how to identify them before it's too late. While some bad investments are obvious scams, others are more subtle. They might look professional, have flashy marketing, or even be endorsed by well-known personalities. But if you pay close attention, there are always warning signs. Here are the biggest red flags that an investment is either too risky, unsustainable, or a scam. Guaranteed high returns with no risk. One of the biggest lies in investing is the promise of high returns with little to no risk. No legitimate investment can guarantee massive profits without any possibility of loss. Even the safest investments like government bonds or blue-chip stocks have fluctuations. Scammers and promoters of bad investments use the word guaranteed to make their offers seem risk-free. They will claim that the investment has never lost money, that it will always grow, or that their strategy is foolproof. But in reality, investments are always subject to market conditions, business performance, and economic factors. If someone tells you that you can earn 10% per month, 30% in 3 months, or double your money in a year with zero risk, that should be an immediate red flag. Unclear or overly complex business model. If you can't easily explain how an investment makes money, that's a problem. A good investment should have a clear and logical way of generating returns. Many scams and unsustainable business models rely on making their operations sound complicated on purpose. They use technical jargon, vague descriptions, or overly complex structures to confuse investors. Instead of showing real financial statements or revenue sources, they throw around buzzwords like AI-powered trading, innovative yield farming, or exclusive wealth generation formula. A legitimate business should be able to explain its revenue model in simple terms. If an investment's explanation sounds confusing, overly technical, or avoids direct answers, it's best to walk away. Heavy emphasis on recruitment instead of profits. Any investment that requires you to recruit others to make money is a major red flag. While networking and referrals are common in business, an investment should stand on its own merits. Pyramid schemes and many MLMs disguise themselves as investment opportunities, but their real source of income is recruitment, not actual business activity. If most of the profits come from bringing in new investors instead of selling products or generating returns from real assets, then the system is unsustainable. At first, early investors may see profits as new members join. But as recruitment slows down, the system collapses, and those at the bottom lose their money. If an opportunity pressures you to bring in new people rather than focus on actual returns, be extremely cautious. Difficulty withdrawing money. One of the clearest warning signs of a bad investment is when you have trouble withdrawing your money. Some investment scams start off by allowing small withdrawals to build trust. But as more people invest, they start delaying or blocking withdrawals altogether. They may come up with excuses like, "The system is down for maintenance. We are currently processing high volumes of requests. You need to reinvest to access your funds." In legitimate investments, you should always have a clear exit strategy. Stocks, mutual funds, and real estate may have liquidity limitations, but they don't prevent you from withdrawing when needed. If an investment makes it hard for you to get your money out, that's a strong sign that something is wrong. No registration with the SEC or other regulatory bodies. Before investing in anything, always check if the company is registered with the Securities and Exchange Commission or other relevant financial authorities. While registration alone doesn't guarantee success, it provides a layer of protection. Legitimate investments like stocks, mutual funds, and bonds are regulated by agencies such as the SEC, the BSB, and the Insurance Commission. These institutions ensure that companies follow transparency rules and operate within legal guidelines. Scams and illegal investment schemes often operate without proper registration. They might claim that they don't need approval because they are private, exclusive, or operating internationally. Some even show fake documents to appear legitimate. Before putting in any money, always verify the company's status with the SEC's website or through BSB's list of licensed financial institutions. If an investment is not registered or has been flagged as unauthorized, avoid it completely. These are just some of the biggest warning signs of a bad investment. In the next section, we'll go deeper into how scammers convince people to invest and how to protect yourself from their tactics. Even with obvious red flags, people still fall for bad investments. Scammers are experts at making their schemes look legitimate, using psychological tricks and marketing strategies to convince investors. Even experienced professionals have been fooled by well-crafted scams. In this section, we'll break down the most common tactics used by scammers and promoters of bad investments, and how you can protect yourself from them. The illusion of legitimacy. Many scams don't look like scams at first. They go out of their way to appear professional, credible, and trustworthy. They do this in several ways. Fake registrations and licenses. Some scams provide fake SEC, BSB, or DTI registrations to make themselves seem legitimate. They may also misuse existing legal documents to confuse investors. Luxurious branding. A well-designed website, a fancy office, or promotional videos featuring expensive cars and luxury lifestyles create the illusion that the company is successful. Paid endorsements. Scammers sometimes pay influencers, celebrities, or even professionals to promote their investment, making it look more trustworthy. Media appearances. Some fraudulent companies get featured in news articles, TV shows, or business forums to gain credibility, even though their investment model is flawed. The key to spotting these tactics is to focus on actual financial data and regulatory approvals, not just appearances. No amount of branding or endorsements can change a bad investment into a good one. Playing with emotions, greed, and fear. Scammers know that emotions drive investment decisions more than logic. They manipulate people by using two powerful emotions: greed and fear. Greed. Scammers promise life-changing returns to make people focus on potential rewards instead of the risks. They create urgency by saying, "Invest now before it's too late," or "only a few spots left." Fear. They also use fear to push people into investing. They might say, "The stock market is crashing. This is the only safe investment," or "You'll miss out on financial freedom if you don't act now." The best defense against emotional manipulation is to pause and analyze. If an investment makes you feel rushed or pressured, take a step back and do proper research before making any decisions. The use of fake success stories. Scammers often showcase success stories from supposed investors who made huge profits. These testimonials may come from actors or paid promoters. Some companies hire people to pose as successful investors. Early investors who got lucky. In Ponzi schemes, the first batch of investors may receive real payouts, making them believe the system works. They then convince others to invest, unknowingly helping the scam grow. Manipulated screenshots. Some platforms show fake account balances or doctored transaction histories to make it look like people are making money. The best way to verify success claims is to check independent reviews and real financial performance. If a company relies more on testimonials than actual investment returns, be suspicious. Overcomplicated explanations. To avoid questions, many scammers make their investment models sound extremely complex. They throw around technical terms and vague phrases like proprietary AI-driven trading system, exclusive decentralized financial strategy, multi-level passive income network. The goal is to make people feel that they are missing out on something innovative, even if they don't fully understand how it works. Legitimate investments can always be explained in simple terms. If you ask how an investment generates money and the answer is confusing or unclear, that's a red flag. Initial small payouts to build trust. Many scams don't collapse right away. They actually pay early investors small amounts at first to gain trust. Ponzi schemes pay initial investors using money from new investors. This makes it seem like the system is working, encouraging people to invest even more. Some platforms allow small withdrawals, but delay larger ones. This creates the illusion of legitimacy while preventing too much money from leaving at once. As long as new investors keep joining, the scam remains afloat. But once withdrawals exceed new investments, the system crashes and people lose everything. If a company aggressively promotes initial payouts as proof that the system works, be cautious. Legitimate investments focus on long-term performance, not just short-term gains. Now that we understand how scammers and bad investments fool people, let's move on to the final and most important part: how to protect yourself and make smarter investment decisions. Knowing the red flags and common scam tactics is important, but that's only half the battle. The best way to safeguard your hard-earned money is to build strong financial habits that help you make smarter investment decisions. In this final section, we'll go over the key strategies to protect yourself from bad investments and ensure that your money is working for you, not for scammers or unsustainable schemes. Always verify legitimacy with the SEC, BSB, or IC. Before investing in anything, always check if the company is registered with the SEC, BSB, or the IC. Here's how to verify. Visit the SEC website and check their list of registered corporations and those with investment warnings. Check the BSB website for a list of licensed banks and financial institutions. Verify with the Insurance Commission if an insurance-related investment is legitimate. If a company claims to be too exclusive or not required to register, that's a huge red flag. Legitimate investment companies always operate under regulatory oversight. Ask, how does this investment actually make money? A legitimate investment should have a clear and logical revenue model. If someone offers you an investment opportunity, ask them directly, where does the money come from? If the answer is too vague or overly complex, that's a red flag. If the profits rely on recruitment rather than actual business operations, walk away. If they dodge the question or tell you that you don't need to understand, it's best to avoid it entirely. Successful investments, whether stocks, bonds, real estate, or legitimate businesses, always have transparent ways of generating profits. Never invest in anything you don't fully understand. One of the biggest mistakes investors make is putting money into something they don't fully understand, just because it sounds promising. Before investing, take time to research and educate yourself. If it's stocks, study the company's financials and market position. If it's real estate, analyze location demand and rental potential. If it's crypto, understand the technology and risks involved. Never invest just because someone else made money from it. What works for others may not work for you, especially if you don't know how the investment actually operates. Avoid too good to be true returns. As a rule of thumb, if an investment promises monthly returns of 10% or more, it's likely a scam or extremely risky. If it guarantees zero risk and high profits, it's unrealistic. If the returns seem much higher than traditional investments, something is off. Compare the investment's returns with legitimate options. Government bonds, 4 to 7% per year. Stock market on long-term average, 8 to 12% per year. Mutual funds and REITs, 6 to 10% per year. If an investment is promising 30% per month or 200% in a year, ask yourself, how is that even possible? Watch out for pressure tactics. Scammers and promoters of bad investments often pressure you to act fast. They use phrases like, "This opportunity won't last long. You'll regret it if you don't invest now. Big investors are already joining. Don't be left behind." Legitimate investments don't rush you. If someone is pushing you to invest quickly without giving you time to research, They're trying to prevent you from seeing the red flags. A real investment will always be available and transparent, and it won't disappear overnight just because you took your time to analyze it. Diversify and don't put all your money in one investment. One way to reduce the risk of bad investments is to spread your money across different assets instead of putting everything into one opportunity. A good diversified portfolio could include stocks, blue-chip companies, index funds, bonds, government, corporate, real estate, rental properties, REITs, savings, and emergency funds for liquidity. Even if one investment fails, your entire financial future won't collapse. Putting all your money into one investment, even if it seems promising, is a dangerous move. Follow the golden rule. If you have doubts, don't invest. If something feels off about an investment, trust your instincts. Take a step back, research more, and consult with experts before making a decision. A good investment should give you clarity, transparency, and confidence, not confusion, pressure, or fear of missing out. Bad investments are everywhere, but with the right knowledge, you can avoid falling victim to scams and high-risk schemes. The key is to always ask the right questions, verify legitimacy, and never rush into decisions based on hype or emotion. At the end of the day, the best way to grow your wealth is through smart, informed investing, not quick schemes that promise easy money. So before you invest, always remember, if it sounds too good to be true, it probably is. Thank you for watching. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell for more content on smart investing and personal finance. See you in the next one.